Hi. Let's learn about commercial mortgage-backed securities. Commercial mortgage-backed securities are fixed-income investment products that are backed by mortgages on commercial properties rather than residential real estate. CMBS can provide liquidity to real estate investors and commercial lenders alike. Because there are no rules for standardizing the structures of CMBS, their valuations can be difficult. The underlying securities of CMBS may include commercial mortgages of varying terms, values, and property types, such as multifamily dwellings and commercial real estate. CMBS can offer less prepayment risk than residential mortgage-backed securities, RMBS, as the term on commercial mortgages is generally fixed. Commercial mortgage-backed securities are in the form of bonds. The mortgage loans that form a single commercial mortgage-backed security act as the collateral in the event of default, with principal and interest passed on to investors. The loans are typically contained within a trust, with different terms, property types, and amounts. The underlying loans that are securitized into CMBS include loans for properties such as apartment buildings, factories, hotels, office buildings, office parks, and shopping malls, often within the same trust. The mortgages that back CMBS are classified into tranches according to their levels of credit risk, which typically are ranked from senior to lower quality. The tranches are usually divided as follows. The lowest tranche in a CMBS structure will contain the riskiest loans in the portfolio. Investors should understand, however, that in the case of a default on one or more loans in a CMBS, the highest tranches must be fully paid off, with interest, before the lower tranches will receive any funds. Typically, only very wealthy investors invest in CMBS because there are not many options here for the average investor. It's difficult to find mutual funds or exchange-traded funds that invest solely in this asset class, though many real estate mutual funds invest a portion of their portfolios into CMBS. In December 2016, the Securities and Exchange Commission and Financial Industry Regulatory Authority, FINRA, introduced new regulations to mitigate some of the risks of CMBS by creating margin requirements for covered agency transactions, including collateralized mortgage obligations. Here are 3 key takeaways. 1. CMBS are secured by mortgages on commercial properties rather than residential real estate. 2. Commercial mortgage-backed securities are in the form of bonds, and the underlying loans typically are contained within trusts. 3. The loans in a CMBS act as collateral, with principal and interest passed on to investors, in the event of default. Hope this would help. Thanks for watching.